Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I think it's starting to get serious here. Here's the news today again on Apple. Apple iPhone shipments in China fell about 33% in February from a year earlier, according to official data, extending a slump in demand for the flagship device in its most important overseas market. This is getting my attention now. I need to check in with Mandeep Singh. He's our senior tech analyst for Bloomberg Intelligence. Mandeep, 1 month, okay, 2 months, it's starting to stack up here. What are we hearing from Cupertino about China risk and opportunities for them?
Right now, I think the two data points that we got this year, one in February from this source called Counterpoint, where they said iPhone sales were down 24% for 6 weeks. Now it's validated that they're actually down 33% for the month of February. So clearly, they have a problem both with the demand for iPhone as well as competition. I think one of the things that doesn't get as much attention right now is the fact that Huawei has a comparable phone to iPhone. And the reason they have been able to do it very quickly is because of the supply chains that Apple created in the region. So a lot of those suppliers are actually making the phone for Huawei. And they don't have to do much because Apple is at the cutting edge when it comes to the chip, the assembly. And so all the supply chains guys are actually diversifying themselves and making phones for Xiaomi, Huawei. Huawei is the notable share gainer here, but that just goes to show that, they are also diversifying.
Which also goes to show why Tim Cook is in China and staying that extra day to meet with quote-unquote top leadership, which everyone seems to think is Xi Jinping. What's going to be his pitch?
Look, I think Apple...
Please use my phones.
Yes, and they used to have 20% revenue exposure to China. It's gone down to about 15% now. But when you think about the weight of China, both as their biggest supply chain, 95, 98% supply chain still resides in China, and 15% revenue exposure, he doesn't have a choice. And that's where he has to make sure, he's aligned with the party and, the locals, and they just want to make sure they don't end up losing share. Forget about growing in the region. It's all about keeping the share they have right now.
I don't know the answer. I can't think of an answer for Apple, particularly on the supply chain. I can pencil out China going to close to zero in terms of sales. I could pencil that out, put a multiple on it, and there we go. There is no Apple without China in terms of supply chain. There is no Apple without that supply chain.
And for the longest time, we thought the risk for the suppliers is if Apple is not giving business to them, they don't have anything to manufacture. Well, guess what? They have, Huawei and the local guys. And so that's how they are going about the business right now. So
if I'm Tim Cook and I have seen this for years and I want to diversify my supply chain, what does that look like? What is that?
We did a big report. It's a multi-year.
Of course you did.
Yes, and the assembly part is already moving to India. We've seen a big ramp up in India. Almost 22% of the phones last year, iPhones, not the highest end, but a lot of the models were assembled in India. And gradually, they will have to diversify, the assembly side. The problem they are running into is all the components that you need to manufacture an iPhone and the complex device that it is, it's not that easy to just, lift and shift your supply chains into a different regions. You need there's so many dependencies, both with TSMC and the other suppliers that feed into the Chinese assembly. So all that needs to be relocated, and it will happen. It's a multi-year effort. And right now the focus is also shifting towards on-device AI. I feel the reason why the Chinese government is really cracking down is because the next wave of this is AI will run on device, and they don't want a US-based company probably to be running AI on device in the region. So that's the other aspect of it.
Year to date, stock's down 11%. Trailing 12 months, it's up 7%. Boy, I can make it from here. A bear case could be made here, big time.
Look.
A long-term, multi-year bear case here. I've got supply chain issues. I've already zeroed out my China revenue. And
Services revenue is going to be changing because of all the new laws, right? In terms of court cases.
Could be.
Yeah, the DOJ lawsuit, it's coming at the worst time for Apple. I mean, they should be doubling down on other markets where they can acquire share that they may end up losing in China. Obviously, the DOJ lawsuit is not helping, and the EU regulation, the Digital Markets Act. So from a regulatory perspective, you're right. I think the bear case is really around the revenue exposure, and I'm sure the supply chains, they'll muddle through in terms of making sure they can still make the phone. And, as long as the manufacturers over there are getting the business, they don't mind Apple continuing to, have the supply chains remain intact there. But I think the hard part would be the EPS drawdown as a result of the Chinese revenue going down.
I mean, I'm 32 buys, 18 holds out there, and 5 sells. That's about as middle of the road as I've seen Apple in 20 years in terms of the street.
And its weighting in the S&P is also falling.
Yeah.
That too. So,
I equate it's similar to Tesla, actually. In some ways, Tesla and Apple are very similar because Tesla also has a revenue exposure. It also manufactures its cars. But I think Tesla's supply chain is more diversified. That's the one big difference is they do manufacture elsewhere.
Here's a dumb question. Why can't they just build stuff in the U.S.? Like, I know it's not as easy as, like, here's a plant, let's plop it down in the U.S. But, like, why is India the next port of call? Like, why not the U.S.?
Well, again, it's the components. So think of the bill of, there are certain components that can only be sourced over there. And over time, they can move things around. But if you're talking about, a $1,200 phone, it has a certain bill of materials, things are done in a certain way. That's why it comes at that cost. We're not talking about a $5,000 phone. If they relocate things overnight, that price could double, triple.
I mean, okay, that's crazy. But do you remember when the iPhone was coming out at $1,000 and it was like, no one's going to pay that. This is insane. This is ridiculous. And now it's like $1,200, whatever.
Yeah, exactly. The market adapts, as we've seen here. All right, so if you're a bull, are you simply saying, there's 2 billion units out there. They'll figure out a way to make money off of those things and that ecosystem?
I mean, the bull case is still the ecosystem and the fact that they have an installed base of 1.3 billion users, who still have the iPhone and they will refresh the phone at some point. And everyone still likes the iOS ecosystem. I think what Huawei is doing is laying out a path where people can move out of the iOS ecosystem, and then the whole AI thing and the regulatory stuff, I think, is just making it worse. The timing of it is just worse for Apple right now.
Interesting. So the developer conference in June, right? The pressure is going to be big for them to deliver something.
And remember, they're looking at leveraging Baidu now. The reason for leveraging Baidu for AI in Chinese region is just to please, the fact that they're using a local AI player as opposed to deploying their own AI. So that's the other aspect of it. AI.
All right. Mandeep Singh, thank you so much. He's the best. Mandeep Singh.
Seriously.
He covers all the technology for Bloomberg Intelligence along with Anurag Rana and a whole team around the globe, London, New York, out in Silicon Valley. We've got a big team in Asia as well. So we've got the global tech space covered head to toe there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Michael McKee joins us, our global economics editor here. And Michael, when we see a bridge in a major port city like Baltimore collapse into the river, there are economic implications here. And we're just learning more and more about Baltimore as a port city, Baltimore as a city where a lot of cargo transits over that bridge. How are you thinking about it from, I guess, a regional economic impact?
Well, it's a regional impact and to a certain extent a national impact because of the type of cargo that Baltimore handles. It is the largest port for automobile imports.
And I didn't know that before
almost
today.
900,000 cars and other trucks came through there. Plus, they also handle what they call roll-on, roll-offs for big companies like Caterpillar and John Deere. So a lot of equipment goes through that port. It is one of the bigger ports on the east coast of the U.S. So there's going to be an interruption there. First of all, because there's no way to get in or out of the port at the moment until they clear the wreckage of the bridge. Bloomberg's trade people have noted there's 21 ships behind the bridge that can't get out again. And then there are more that would be coming in that in theory can be diverted, but it's going to be a question of capacity for getting the tonnage off those ships in other ports.
It's interesting. I have to admit, I am a kind of a trade shipping geek, and I have an app on my phone that tracks this stuff. So I'm sitting on the Jersey Shore beach, and I see a big cargo ship go by. I want to know where it came from, where it's going, what it's carrying. And what I do notice is the ones leaving the New York Harbor, often the next stop is actually Norfolk, Virginia, more so than you would say Philadelphia or Baltimore. So perhaps, but I can't imagine putting 900,000 cars. Who's got room for that?
Right,
Years? So that's a challenge.
That's going to be a bit of an issue. They also, it's a major distribution hub there on the north side of the bridge. They have Amazon, FedEx, Under Armour, Home Depot. They all have big warehouses there, and the stuff that comes in and out to those warehouses, and this will be more of a regional impact, but won't be coming in and out. So there's going to have to be a lot of logistical changes made. Now the good news is, to the extent that this, I don't know if it's good news or not, but we have had some bridge collapses in recent years. Remember in Minnesota and in the Bay Bridge in Oakland. Others like that have happened. Philadelphia had the I-95 bridge, and putting a bridge back together is easier than building it from scratch. Now this is a much worse. This is a much worse situation than those. But they were able to get them rebuilt on a fairly quick timetable. It took 5 years to build this bridge. So the hope is it would not take that long to rebuild this bridge.
So let me ask. How long, this is a completely unfair question to give you in a minute, but how long does it take for these kind of issues to filter down into prices, for example? And then how does the Fed going to look at it? Because yes, it's transitory, but 2.5 years and then the confidence and the expectation of inflation, that isn't transitory.
Well, it's hard to say at this point because companies are much better, and the pandemic forced them to be much better at being able to change their supply routes and supply lines on short notice. If we don't get stuff or we can't ship stuff, it will raise the price probably, but it has to last for a while if they can find alternate ways around it. Transportation is a very, very small part of overall goods prices, so it's probably not going to have a major national impact. It may have an impact certainly on Baltimore, and obviously it's going to be a major impact for a while in terms of traffic going up and down Interstate 95. Probably the biggest impact is going to be with hazardous materials, because they can't go through the two Baltimore tunnels. They could only go over the bridge. So now they're going to have to make a wide detour around Baltimore. That'll slow things down.
All right, Michael McKee, thank you so much. We appreciate that. Michael McKee, our economics editor.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Okay, let's get to some breaking data we had at the top of the hour, and that's consumer confidence. So the Conference Board Consumer Confidence for March coming in a little light, coming in at 104.7. Also, February was revised lower. The present situation a bit better, 151, but it was the expectation number that disappointed, coming in at 73.8. So let's dig through the numbers here. Joining us is Dana Peterson, Chief Economist at the Conference Board. Dana, what led to the lower expectation number?
Sure. The expectations number is made up of three pieces: employment, incomes, and business conditions, and all three were down in the month.
What does that tell us?
Well, it tells us that consumers are a little bit worried about the future. Certainly this expectations gauge has been dancing in and around 80, and 80 really is the threshold for which below that consumers think there's a recession coming. But we also do have a separate recession question where we ask consumers, do you think there's going to be a recession over the next 12 months? And they've been continuing to be less convinced of that. So there's some mixed implications here. Certainly they are a little bit concerned, but they don't think a recession's on the way.
So, Dana, it seems like from all the polling you see out there that inflation is probably issue number one with consumers out there. Yes, the rate of inflation has declined, but boy, prices are still high, whether it's food in the supermarket, gasoline for your car. What's your data show you about that?
Sure, we have write-ins where we ask consumers what's your most important issue, and complaints about inflation and prices are still number one. They're still complaining about food and energy prices, but in terms of energy, the complaints are a little less severe, a little less intense, so consumers are seeing a little bit of a break there, but for the most part, they're still very worried about prices being elevated, eggs and gasoline costing more than they'd like.
Yeah, ... because you take a look, there's a survey out that shows that gasoline in the summer could top $4 now. So there is that coming out there. You look cocoa prices, topping $10,000. And then you have this issue at the port of Baltimore, right? And then you have this bridge collapse. And that could wind up affecting supply chains, etc. How do consumers react to these kind of headlines, right? $4 gasoline, bridge collapse. Like, how does this affect their level of confidence and their level of spending?
Sure. I mean, we can't tell from this report because the data was fielded.
Sure.
Survey was fielded before this happened this morning. But certainly, if consumers think that there's going to be higher gasoline prices or that supply chain disruptions from the incident in Baltimore are going to make clothing and cars more expensive, then certainly their confidence is probably going to wane.
All right, Dana, thank you so much for joining us. Dana Peterson, she's the chief economist at the Conference Board. We had the Conference Board coming out with some consumer confidence data today, a little bit weaker than expected, and some downward revisions from the prior month. So again, consumers a little bit wavering, some confidence out there as inflation remains stubborn for many folks out there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, let's see what's happening with these markets. Let's check in with somebody who does this stuff for a living. Carol Schleif, Chief Investment Officer of BMO Family Office, located there in Minneapolis, and she's joining us via Zoom. So, Carol, what do you make of this market here? What's driving stock prices higher, in your opinion?
I think there's a growing belief that whether it's not even a soft landing, it's no landing at all, there's a growing belief in the sturdiness of the economy and what's going on in the U.S. There's also a lot of fiscal stimulus that's finally freed up. It's been teed up for the last couple of years, and now it's actually moving into markets and supporting things. We're doing exciting things like reshoring. We're building artificial intelligence, data center hubs. There's a lot of activity going on. And if you look under the hood at what the markets are showing, they're showing it's not just those magnificent seven leading the pack anymore. It's a much broader basis. And you've seen a broadening out of the leadership, which is very reassuring and supportive for constructive markets.
So, again, a lot of folks, I guess we did see that in that November, December move in the market, a broadening out of performance. How important is that for the market? Because it just seems like technology's got to lead this market, but you need to see how some other sectors participate as well.
Yeah, it's definitely important for the sustainability and durability of a market advance to have most of the participants or most of the constituents participating. And you're definitely seeing that. You're seeing a turnover where you've got stabilization, some interesting things going on with financial services. You've got consumer goods companies moving, both staples but more particularly the discretionary side of things. We'll have earnings coming up in a couple of weeks, so we'll be able to start parsing through some of that. But it really is vital for the ability of the markets to carry on, that more and more are participating in it. And it's interesting, on a day like today, even a lot of those Magnificent Seven aren't in the top tier. They're holding their own, but they're way down the list of contributors. And so it's really important for this market to continue to see more and more stocks participating.
How do you judge that, Carol? I mean, because they're not going to be able to catch up to like pre-pandemic levels. You can make an argument, like maybe energy and industrials we've seen, but how do you know which sectors are going to be able to have that real bounce and which ones are just going to be too exposed to rates, say, and the consumer?
I think it's really important to not necessarily just invest sectors, but what you saw, especially in the last quarterly earnings, is you saw a big dispersion even within sectors in terms of who was adapting to higher rates, who wasn't, who was adapting to higher costs, who wasn't. You saw a lot of credit attributed to individual companies that talked about right sizing businesses where they were laying off in one part and investing strategically in another. So it really is a stock picker's market. So maybe the bigger question is, do we go back to a predominance of active management and those active managers who are able to parse through the companies that are really able to accommodate? But one of the things that's helpful as companies try to figure out can they adjust to an overall higher terminal rate is if the Fed is done raising rates, which they seem for all intents and purposes to have indicated in a variety of ways that they're done raising, regardless of when they start to lower, it's easier to model out what impacts rates have if they're not continuing to rise. At least you can figure out what your cost of capital is and play that through. So, it's a real arduous task, if you will, because it's a company by company, not necessarily industry by industry exercise.
Are there some sectors, given that, it's a bottoms up picker's market in some people's perspective, are there some sectors that generally you guys are favoring at this point?
Yeah, there's a variety of sectors. We've liked industrials for a very long period of time, not the least of which is because the fiscal stimulus tied up or teed up, if you will, for those sectors. We've liked industrials. We do think financials will need to play. Healthcare is very important as well, and there's a lot of innovation going on in medical devices, biotechnology, services, lots of different things that are benefiting. And technology and communication services are important as well because as you mentioned, there's such a significant component and they filter over into virtually every other industry as well.
What do you do? This is totally talking my own book, but some of the stocks that have done really well this quarter is Constellation Energy. It's a straight up nuclear power company. And that has done really well as a derivative play of data centers and AI because you need so much power. And I'm wondering if this is like the octopus legs for AI, like you have to go into those sectors that will also really benefit. How do you think about that?
Yeah, I think it's really important because it's not just, to me, it parallels very much what happened in the first internet build out in the 95 to 2000. You had a lot of short-term exuberance around anybody who could put .com in their name. Mm-hmm. But the more important longer-term play there were the people building out the actual infrastructures, the routers, the data centers at the time. And similarly here, it really is the play on, it's great to say you're going to put up a data center, but you have to hook it to the energy grid. You also have to make sure you have water rights for the cooling technology there. So there's a lot of secondary and tertiary knock-on effects that go there. And so I think investing more broadly that way, because artificial intelligence, data centers, reshoring, all of that stuff is not just a short-term cyclical play, it's a secular play. And so figuring out who's going to benefit and where the stocks may not have moved. Now, Constellation may have moved, but there are other broader implications for those industries that you're spot on in terms of highlighting those. So,
outside of, we're going to have earnings you mentioned in a couple of weeks. What are you going to be looking for here? I mean, I'm thinking about valuation in this market, Carol. I mean, we've seen big moves off the October lows. I'm not sure I've seen a commensurate move higher in analyst estimates here. What's your valuation call and how important are earnings coming up?
Well, earnings will be really important to watch and listen for, and there'll be a lot, as there have been in the last few quarters. There'll be a lot of analysis, not just of where the earnings come in, but what the companies say in those transcripts and in those earnings calls. And people will be watching pricing power, what they're doing with employment, what they're doing with CapEx and expansion plans, what they might be doing with mergers and acquisitions, how much cash is on the balance sheet. There'll be a lot of details that people will be looking for in those earnings. And you're right, valuations are not cheap. They're not hyper expensive necessarily, and particularly when you look at technology and the way that those growth trends have come in, those growth trends have supported where the stock price movements may have gone, even though valuations are somewhat high. But critical sectors to watch will be those consumer names. How much pricing power do they have? Because it does feel like in the last couple of quarters, there's a lot of consumer pushback in terms of what the grocery bill is going to cost or what they're willing to spend on and what they're not willing to spend on. But consumers are still spending, companies are still spending. So
before we let you go, what do you think the lever will be? Because I feel like in the last earnings season, we did learn that the pricing power of companies had kind of hit its max. Then the levers to keep the margins going, what is it going to be?
Well, I think on the intermediate and longer term, investors have to realize that margins are at or close to all-time highs. In terms of growing that and sustaining that gets to be pretty tough. But companies will be looking at, is there somewhat of an easing in, because there was a lot of pressure on employee salaries and overall income and the hiring. You've seen employment come into better balance, so hopefully people won't be as pressured to offer substantial signing bonuses and increases, although it would be nice from a consumer standpoint to at least keep pace with where the inflation rate is. So companies will be parsing every item they have in terms of looking at cost efficiencies and where they can save a buck there. But it'll be tough. And as investors, we're going to have to adjust to the fact that margins can't grow to the moon any more than stock prices necessarily can.
Okay. Cal, thank you so much for joining us. Really appreciate it. Cal Schleif, she's the Chief Investment Officer at BMO Family Office. We appreciate getting some of her thoughts.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
President Joe Biden has gained some ground against Republican Donald Trump in 6 of 7 key swing states. So I want to get more on this with real economy reporter for Bloomberg, Mark Niquette. He's joining us on this poll. What are the findings that you have?
Well, the poll shows, it's a monthly tracking poll that we've been doing since October, and it shows that Trump's still doing pretty well in Georgia, Arizona, Nevada. But the most significant findings is that Biden has improved his standing in Michigan, Wisconsin, and Pennsylvania, sort of the blue wall. I think these states are going to decide the election, and he needs to win these states if he's going to get a second term. In Wisconsin, Biden now holds a 1-point lead over Trump after trailing him by 4 points in February. In Pennsylvania, the candidates are tied after Trump had a 6-point lead in February, and they're also tied in Michigan.
Any common denominator here, Mark, as to what might be driving some of these poll numbers?
Well, the timing of the poll was interesting. It was conducted March 8th through the 15th in the swing states. And that March 8th is the day after Biden's State of the Union address, which was pretty fiery and I think, alleviated some Democratic concerns about the president's age and his fitness to take on Trump a second time in a rematch. And it's also midway about March 12th is Super Tuesday, when both Biden and Trump sort of clinch the respective nominations. They got enough delegates to clinch. So it kind of really made it a binary choice. We knew this was going to be the outcome, but I think the Democrats in particular were thinking that until it was really clear in voters' minds that this was going to be a rematch and it was Trump or Biden, that's their choices, that, Biden was not going to do as well in the polls. Mm-hmm. So this is sort of the first poll that, we have it clearly established that it's going to be a Trump-Biden rematch.
Are voters voting because they like the candidates or because they don't like the other one?
Well, interestingly, our poll showed that in the case of Trump, most of the support is coming from people who like Trump. Only 3 in 10 Trump supporters said they were voting for Trump because they didn't like Biden. They're essentially voting against Biden. But the case was different for Biden. About half the supporters of Biden said they were voting for the president essentially as a vote against Trump. They didn't want to see Trump get back into the White House. It was even more pronounced in Wisconsin, where like 6 in 10 of the supporters of Biden were voting for him because they were voting against Trump.
To that point, are those voters more sticky or not? Like, is the anti-vote stickier than the pro-vote?
Well, this is what we're going to find out, is what's more motivating, right? Support for your candidate or desire not to see the other candidate win. I think Trump has benefited over time from enthusiastic support from his base and base turning out to support for him. But the negative feeling can also be a very strong motivating factor and could drive folks to the polls specifically to vote against Donald Trump because they don't want to see him back in the White House. We're going to find out what's more motivating, voting for your guy or voting against the other guy.
What does the polling show about some of these swing voters, the more independent folks? See, what I've been told, or we've been told by a lot of pollsters, is that the core Trump folks are going to stay with Trump no matter what, and probably something similar on the Democratic side. It's the folks in the middle. What do we know now?
I think we still don't know exactly how those folks are going to play out, because we're particularly interested in how suburban voters, particularly suburban women, are going to vote in this election. And we've seen, even in our tracking poll, changes in that subgroup, particularly in views about the economy. So I think we have to get closer to the election to really see how these folks are going to play out. And it's going to be, maybe the deciding factor, how these independents and in particular suburban voters, decide between Trump and Biden. And frankly, how motivated they are to turn out, because particularly, but if Biden's going to win these swing states, particularly Wisconsin, Pennsylvania, and Michigan, he's going to need a very strong turnout in Democratic cities.
Mm-hmm. Do what voters care about, did that change at all month to month?
Interestingly, we saw a little bit of a decline in the importance of the economy as a top issue for voters, and an increase in immigration as a top issue. So sort of a loosening of the economy and a more heightened emphasis on immigration, which presumably would be bad news for President Biden. But we also saw folks who trust Trump more than Biden on the economy, that number go down a little bit. And also the folks who feel they were better off financially under Trump than Biden also go down a little bit. So we're seeing a little bit of softening of the advantage that Trump had on the economy, and in particular how voters feel about the economy.
Mark, 30 seconds. How about the age issue? Both sides are playing that up at the expense of the other.
Yeah, exactly. And I think, the one takeaway from this poll is, Biden is sort of helped in that regard. I think primarily because of his State of the Union address. Age is still is a concern. It will be a concern, I think, up until the election. But if nothing else, Democrats, I think, feel a little more comfortable that it's not going to be a decisive issue that's going to sink Biden's campaign.
All right. Great stuff. Really appreciate it. Thank you very much. We look forward to the next poll as well. Mark Niquette, he's Bloomberg Real Economy reporter, joining us in the latest morning consult poll. I want to see what, apparently in the poll too, Nikki Haley voters seem to be moving towards Trump, which I found to be quite interesting because, why?
I don't.
But then is that like an anti-Biden thing versus a pro-Trump thing?
It's interesting. We'll have to see when we get closer to the election, see how some of these things start breaking here.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.